The growth of the economy is central to the decision to buy or sell dollars. Because of the perceived safety and ability to achieve an acceptable rate of return on investment, a strong economy will attract investment from all over the world. Because investors are always looking for the highest yield that is predictable or as safe, an increase in investment, particularly from abroad, creates a strong capital account and a high demand for dollars. American consumption, on the other hand, results in the importation of goods and services from other countries, causing dollars to flow out of the country. If our imports exceed our exports, we will have a current account deficit. A strong economy can attract foreign capital to help offset a country's trade deficit. This allows the United States to maintain its role as the consumption engine that drives all of the world's economies, despite the fact that it is a debtor nation that borrows money to consume. This also allows other countries to export to the United States while maintaining their own economy's growth. When it comes to currency trading, when it comes to taking a position in the dollar, the trader must assess these various factors that affect the value of the dollar in order to determine a direction or trend. The methodology for determining dollar value trades is divided into three categories, which are as follows. 1. Supply and demand factors. 2. Sentiment and market psychology. 3. Technical factors. We'll look at each group individually and then see how they work together as a unit in the sections that follow. When the United States exports goods or services, it creates a demand for dollars because customers must pay in dollars for goods and services. As a result, they will have to convert their local currency into dollars by selling their own currency in order to purchase dollars in order to make the payment. Furthermore, when the United States government or large American corporations issue bonds to raise capital, which are then purchased by foreign investors, those payments must also be made in dollars. This also applies to the purchase of U.S. corporate stocks by non-U.S. investors, who must sell their currency in order to buy dollars in order to purchase those stocks. These examples demonstrate how the United States increases demand for dollars, putting pressure on the supply of dollars and increasing the dollar's value relative to the currencies sold to buy dollars. Furthermore, the U.S. dollar is regarded as a safe haven during times of global economic uncertainty. So demand for dollars can frequently persist despite fluctuations in the performance of the U.S. economy. If the U.S. economy weakens and consumption slows as a result of rising unemployment, for example, the U.S. faces the possibility of a sell-off, which could take the form of returning the cash from the sale of bonds or stocks in order to return to their local currency. When foreign investors repurchase their domestic currency, the dollar suffers. Traders must forecast whether the supply of dollars will be greater than or less than the demand for dollars. To assist us in determining this, we must keep an eye out for any news or events that may have an impact on the value of the dollar. This includes the release of various government statistics such as payroll data, GDP data, and other economic data that can help us determine whether the economy is strong or weak. In order to determine general economic sentiment, we must also consider the perspectives of larger market participants, such as investment banks and asset management firms. Sentiment, rather than economic fundamentals such as supply and demand, will frequently drive the market. Traders are also tasked with analyzing historical patterns generated by seasonal factors such as support and resistance levels, and technical indicators to add to this mix of forecasting. Many traders believe that these patterns are cyclical and can be used to forecast price movements in the future. Traders typically use a combination of the above-mentioned methods to make buy or sell decisions. The art of trading is in stacking the odds in your favor, in the form of congruence in the three methodologies, and building an edge. If the trader believes that the probability of being correct is high, he or she will take the risk of entering the market and managing their hypothesis accordingly. The economic conditions that prevailed during the recession that began in 2007 compelled the United States government to play a previously unseen role in the economy. Because economic growth was slowing as a result of the large deleveraging of financial assets, The government was forced to pick up the slack by increasing spending and bolstering the economy. The goal of government spending was to create jobs so that consumers could earn money and spend more, thereby fueling the growth required to sustain economic growth. The government adopted this stance at the expense of a growing deficit and national debt. To summarize, the government essentially printed money and sold government bonds to foreign governments and investors in order to increase the supply of dollars, causing the currency to depreciate. The rise of the US dollar is caused by a number of factors, the most important of which is demand for the currency. When demand for the dollar rises, so does its value. In contrast, as demand falls, so does the value. When international parties such as foreign citizens, foreign central banks, or foreign financial institutions demand more dollars, the demand for the dollar rises. Because the dollar is the world's reserve currency, demand for it is usually high. Inflation rates, trade deficits, and political stability are other factors that influence whether or not the dollar rises in value in comparison to another currency. Currency reserve status, inflation, political stability, interest rates, speculation, trade deficits/surpluses, and public debt are all factors that influence currency exchange rates. A weak currency is one whose value has fallen in relation to another. Weak currencies are those of countries with weak economic fundamentals or ineffective governments. High levels of inequality, political instability, and high levels of corruption, public debt, and trade deficits can all contribute to a weak currency. Aside from paying close attention to market sentiment and technical factors such as government data, a trader may find it useful to keep an eye on the dollar index chart, which provides an overview of how the dollar compares to the other currencies in the index. By watching the patterns on the chart and listening to the major fundamental factors that affect supply and demand, a trader can develop a big picture sense of the flow of dollars and gain insight into how to best select profitable trading positions.